Hi, Shae Russell here, editor of the Daily Reckoning Australia, and I thought we'd take a quick look today at the unemployment data as released by the Australian Bureau of Statistics last week. Now, I'm not going to go into alternative statistics like the ones Roy Morgan produced. We can save that for another video. We'll just stick with official statistics today. Now, the expectation was that somewhere between 10,000 and 30,000 new jobs were added for March. The good news is the data shows that it did fall in line with expectations and around 14,000 new jobs were created. The problem is 13,000 of those were part-time, with only 1,000 of those being full-time jobs. Now, this falling into the lower end of the range means that the unemployment rate increased a tiny little bit from 5.5% to 5.6%. Now, if Australia wants to maintain an unemployment rate of 5.5%, we need to be adding a minimum of 20,000 new jobs each month. If we want to reduce our unemployment rate from the now 5.6%, we need to be adding a minimum of somewhere between 30,000 to 40,000 new jobs each month. Now, last year, a lot of people got their hopes up because 400,000 new jobs were created in total. The problem is 200,000 of those relate to government roles, and almost all of those government roles were because of the NDIS rollout. So what we saw last year was very much a one-off bump, and without some serious government intervention or massive government projects like that, we're unlikely to see a repeat of 2017 employment numbers. However, what does this mean for wage growth and, more importantly, interest rates? So wage growth, with more part-time jobs being added than full-time jobs at the moment, we're unlikely to see that start increasing wages, because at the end of the day, we're still not entirely sure how many part-time jobs are needed to replace a full-time income. Now, the problem for this is without seeing significant wage growth, the RBA are unlikely to raise interest rates. It's sort of a double-edged sword. Now, if we look to the US, for example, the US didn't really start seeing wage growth increase until their unemployment rate fell to 4%, which is around the time the Federal Reserve started their rate hiking cycle. Now, the last time Australia had an unemployment rate of 4% was back when the mining boom was in full swing. Given we're sitting at 5.6 today, we've got a fair way to go for the unemployment rate to fall for 4%. In the meantime, that means it's unlikely the RBA is going to raise rates this year, and unless we see a significant increase in both wage growth and unemployment, there's probably not going to happen next year at this rate either. That's all for me today. As usual, make sure you sign up to our newsletter, The Daily Reckoning Australia, and I'll be back later in the week with more news.